Hello and welcome to another weekly review. My name is Grant Collins and I'm an independent economist with AIM Research. And today I want to give you another update on all the data that came out last week. It was jam-packed. We had the GDP report that came out. We also had an inflation report at the end of the week, but we had some really good data as well on the housing market and on durable goods orders. So we're going to spend a lot of time covering all of that. And then I'm also going to help get you ready for the week ahead and what I think this might mean for the path of policy and maybe even for the path of the market going forward from here. So as always, let's dig into the charts and let's get started. Again, if you remember from the previous week, I've consolidated everything into one chart deck roughly instead of having multiple. So hopefully this will continue to help us as we go along the way. Now, to start the week, we knew coming in that it was going to be a conversation around growth. We knew it was going to be a conversation around the Fed meeting. And there was a lot of, I think, anxiety in the marketplace. That shortly was abated as the week went on, as more and more data came out and more confirmation from the economic data and from the Fed was released. The title of my talk today is Growth Was Strong, but How Strong? I think what you're going to find is that the growth was very isolated and very narrow in parts. And I'm going to show you some things that might give you some additional flavor to the GDP growth rate that was there. So let me walk you through. Let's start with the Chicago Fed National Activity Index. It's interesting. I don't really look at the National Activity Index that much. However, I have been reviewing it in greater detail here lately, and I found out some really interesting things. It's highly correlated with the GDP rate. In fact, the correlation is almost like a 70% correlation going all the way back to 1970. So that's a very high correlation, which makes me think we should pay attention to it. It's a basket of 85 indicators. That's really broad-based. It's spread over 4 categories. Those categories are right in line with the coincidence economic indicators. So it's production, it's income, it's employment, unemployment, and wages and hours worked. It's consumption and housing. And then finally, it's sales, orders, and inventories. Now, the Chicago Federal Reserve Board actually puts out a little statistics on this report because I want to give you some background on it before we start looking at these charts. Some of the things that they highlight here just real quickly. So according to the Chicago Federal Reserve Board, over the past 18 years, the Chicago Fed National Activity Index has had a 95% accuracy in identifying U.S. recessions and expansions. It tends to lead the NRBR Recession Data Committee by 6 to 18 months in real time. It's used to nowcast GDP. It's used to identify the trend rate of growth, and it can be a leading indicator for inflation as well. So it looks like this is an indicator that maybe we should look at more often, even though I currently don't. I'm highlighting it here because it was the first piece of data that we got in the week. It came out on Monday. It came in at minus 0.32. That was lower than the prior month at minus 0.15. Now, what's important, though, about this is how you interpret the reading. The Chicago Fed board actually believes that you should take a 3-month moving average. That's what you're seeing in yellow here. That's minus 0.16. That's right in line, basically, with where it was at the prior month. But if you take that 3-month moving average and the reading is below minus 0.7, then there is an increasing risk of a recession. Now, we're nowhere near that. That's the red line that you're seeing there is minus 0.7. However, there was also another component to this. If the indicator of the 3-month moving average is greater than 0.2%, then you have a recovery taking place. That's the green line on this chart here. You're not getting a recession and you're not getting a recovery. What you're getting is a flatlining. And because the number is negative, anytime you're below 0, you're considered below trend. So this kind of channel that you're seeing here on the chart deck, the green line and the red line, can help us really understand this economic cycle. It's not recessionary. It's not expansionary. It's more in what we would consider that sideways consolidation that we've been talking about. There's been a strong deterioration in the index, just like there's been a strong deterioration in economic growth, but it is not necessarily recessionary just yet, as there's some key components, for instance, like the employment component, that still remains somewhat strong. Now, I think looking at this alone doesn't necessarily give us all the story. We can also look at the diffusion index. The diffusion index is a little wonky, but I want to walk through their statement on here of how they calculate this diffusion. It's important because you can see two things. You can see the cycle component a little bit better, and you can also determine the recessionary readings a little bit better. So let me read this to you real quickly. So a second way to review the Chicago Fed National Activity Index is by using the diffusion index, which is calculated as the sum of the absolute values of the underlying index, so all 85 of those, whose contributions to the index is positive in a given month, less the sum of all those weights for those indicators whose contribution is actually negative or neutral, expressed as a proportion of the total sum of the absolute values according to their weights. Now, again, that's really mathy and a little bit technical in nature, but I think it helps you understand what this diffusion index is. It's trying to strip out those positive and negative readings and try to weight them based on their according value to the overall index. And what you're seeing here is another reading that's negative, minus 0.12, and you're seeing another red line. That red line is actually minus 0.35. Anything above minus 0.35, they consider expansionary. Anything below that, they consider it recessionary. So it definitely looks like from this perspective here that they consider this still an expansionary environment. What's interesting, though, is you're seeing very strong GDP numbers, which we're going to get into at the end of this report. But yet the Chicago Fed National Activity Index, which according to the Federal Reserve Board of Chicago is a leading indicator of the economy, is a great nowcast for GDP growth, and it continues to weaken despite the really strong GDP report that we just received. So I wanted to start off not only talking about the underlying conditions and the underlying indicators that this particular index uses, but also to highlight that it's a strong contrast and gives you a different reading than what you're going to see in the GDP report in just a bit. Now, we did get some other data, specifically new home sale data. A couple periods back, we talked about how housing could be bottoming here. And then last week, I talked about how the improvements could be slowing after we got existing home sale data. We got more confirmation that new home sales are also slowing as well. Just real quickly here, new home sales actually came down. The prior month was for 0.763 million units. It came in at 0.697 million units. So again, a strong reduction there. In fact, sales were down 2.5% below that May rate, which was revised lower as well to 715,000 units. And really, at first glance, I thought this was all still kind of a very similar story, kind of a limited number of inventory, a limited number of supply, very high home prices, very high interest rates. And I think all of those continue to weigh on the housing market. And while we might continue to see some sideways action here, new home sales, I think, accelerated a little bit more than existing home sales, because when I surveyed local business owners that are in the building construction and home construction markets, we were being told that they were providing teaser rates for some of their customers, and that did allow the rate to come down a little bit. And that's so important when you have a 30-year mortgage sitting here at 6.84%. So you can see how that's accelerated quite a bit and how it kind of stalled for a little while here. So maybe that stalling, it could have created some activity, thinking that people wanted to get in before rates moved higher, because at the time, Jerome Powell, because remember, this is a month looking back, Jerome Powell was talking about still raising interest rates. So maybe that did spur a little bit of economic activity, but it looks like that economic activity maybe is starting to cool a little bit. And so I wanted to point that out. And it could be just because a 30-year home loan with that 6.8% and with a $415,000 price tag is going to run you about $2,800 a month. And that's the highest reading that we've seen since the index has been moving up here. So the home affordability track, I think, is in question. And think about the marginal buyer. When we look at some of the existing home sale data from the prior weeks and we comb through the data, all the home being purchased right now are primarily from first-time home purchasers, which is the millennial group. Those millennials are being strapped with student loans. They're being strapped with maybe a credit card or a car loan, and then at the same time, they now maybe have to compete for additional dollars now that home prices have shot up so much. Don't forget that student loan repayments are going to turn back on. I believe in September, the interest rate starts back up, and then in October, first payments are due. So looking at that, that could also be a big decision of why maybe buying a home right now may be on pause for some of those marginal buyers. We'll see. We'll continue to look at that. Despite the trouble and the decline in home sales, however, home prices continue to rise, and home equity, homeowner equity, is lagging by a quarter, but we should expect that to tick up a little bit. That's important primarily because if consumers get into a little bit of a bind here, they have the ability to maybe refinance by using some of this home equity. I have been seeing a lot of charts on credit card usage expanding, and people taking out credit card loans. And it seems bizarre because some of those credit card loans are 22, 23, 28%. This is an avenue for them to likely be able to consolidate and maybe refinance those, is maybe using some of the equity in their home. And maybe that can help alleviate some of their troubles and help keep the cycle going maybe a little longer than some are expecting, at least from the consumer consumption side. Again, you can see the Case-Shiller home price 20 city composite moving higher, and it has a pretty strong correlation with this homeowner equity. Homeowner equity we know is tied to the price, which is why we're looking at this to even begin with. So if price is rising again in the intermediate term here, we would likely see those homeowner equities pick up as well. Now, outside of that, we also got the highly anticipated Fed rate decision. I think it was truly a non-event. I don't feel like Jerome Powell gave us any guidance. He didn't give us any clarity. He continued to leave his options open and continued to want to be flexible after raising interest rates here, because I think they truly don't know. And I think there was a great reflection of I don't know, even though they didn't directly say it. Two things pointed out to me that indicate that the Fed continues to kind of want to wait here and see how the data continues to progress. One was the intermediate pause that they made at the previous meeting. If you're going to go ahead and raise rates anyway, why was it necessary to pause in July and then re-up your conversation and go ahead and raise it again another 0.25%? Well, that tells me that some of the committee members maybe didn't necessarily agree, and so they took a period to try to reach some consensus. That's one thing. The second thing is the change in language between what's coming out from Jerome Powell versus what's being released by Fed staffers. It was mentioned a lot, but Fed staffers removed a recession from their forecasts. They now see just a period of very sanguine growth, and they now see the unemployment rate softening even less than they previously did. Where Jerome Powell continues to highlight that, hey, we need to maybe leave rates higher for longer, so that way the duration of being restrictive continues to put downward pressure on inflation. We need to have unemployment soften a little bit, and we need to have GDP continuing to grow below trend. To me, that's Jerome Powell's way of saying, hey, we need a very soft recession. We need a very mild recession in nature. One that, again, results in some job losses, some wage cooling from here, so that way we can continue to get inflation back down to 2%. Those two things, in my view, kind of highlight why I think the Fed is uncertain, why they're moving into data dependency, which I think is also interesting because they're looking at the data as it comes out, but they're only making meetings or they're only raising interest rates around the quarterly meeting structure, or that in and of itself, to my opinion here, has some issues with it because the data is already out, and unless you make your decision right then and there, then to me it just seems lagging in nature. They need to be more proactive, in my opinion, and maybe data dependence needs to be framed differently than the way that they're currently framing it. One of the other things that he said at his presser is that he expects inflation to return to 2% by 2025. By that measure as well, that's a very long track back to 2%. There's some economists out there that say, hey, maybe there's a new equilibrium. Maybe we need to float the 2% higher to 3%. The 2% was arbitrary in nature anyway. And again, if you introduce more uncertainty into the marketplace with more rate hikes or more tightening of financial conditions, then you might return to 2%, not because you're winning on the inflation front, but because deflation is setting in and it's causing a recession. Right now, according to the Chicago Fed National Activity Index, that's not the case, but there has been a lot of deterioration in the economy as evidence from the manufacturing side, as evidence from the housing side, and as evidence from the financial market, particularly in the financials, where we had Silicon Valley Bank fail and we had a hiccup there as credit started to tighten up a little bit. What else do I think that they should do? We're going to talk about it, but I believe they should stop the interest rate hikes and continue balance sheet runoff. There's so much room here, just a touch over $800 billion, depending on whether you're looking at currency in circulation or whether you're looking at the GDP floor. Being able to allow this to continue to run down is another form of tightening, and I think it's tightening that operates in the background. As some have called it, it's like watching paint dry. And as long as you don't get too close to the floor, I don't think you're going to have a lot of financial market implications, right? Or even interrupting the overall economy. I think the interest rate hikes, because they do operate with a lag, as we talked about last week, lags as short as 12 months or as long as 15 quarters, because those lags are still ongoing. They started raising interest rates in the springtime of 2022. Well, now we're a year and a half into this, and maybe we are still yet to see some of those lags play through here. That's why I think they need to pause here and maybe continue this in the background to continue their form of tightening. So to me, again, I think the Fed, this was a non-event. The market had already priced it in. I don't know if I have a chart on this or not, but you can see the 1 month was already there in blue here, and the 2-year was already working its way back up to the point where, the market already fully anticipated this move here. Okay, so that was the Fed presser in a nutshell. After we got the Federal Reserve report, the following day we moved into durable goods and we moved into the GDP report. This is great timing. We're first going to look at durable goods because it was a really strong report. Durable goods was up 4.7% compared to the prior month of 1.7%. I do want to highlight, however, though, that all of the durable goods report was heavily influenced by transportation equipment, which is what I have a chart on here. Transportation equipment was up 12.1%. That includes things like motor vehicles and parts. That includes non-defense aircrafts. That includes aircraft parts, right? And you can see just the big move here, right? I mean, skyrocketing higher here, and you can even see it on the cyclical perspective. If we remove transportation equipment from the durable goods orders, you see more of kind of a flatlining. Yes, it still moved a little bit higher. I believe it was up 0.6% when you take out transportation equipment. You can definitely see a directional trend lower, and again, maybe a small hook higher here, but I don't think we should be real excited about the durable goods orders when it's so narrow in the transportation sector of the economy. That goes back to a couple weekly reviews that we had prior where we talked about automobiles and how manufacturing has really accelerated on the automobile space. Listening to some other strategists and reading some other research, it seems like that's one of the last sectors that kind of got their bearings back after COVID, now that the supply chain lines have reopened, and now they've been playing catch up here by manufacturing more cars. We'll see how that goes, but definitely, at least from a new orders perspective, I'm taking it with a grain of salt because a lot of it here was transportation equipment. Let's keep coming down here. Let's move on to the GDP report. So the GDP report, just real quickly, was up 2.4% quarter over quarter versus 1.7% quarter over quarter. To me, the gains seemed very isolated. One of the places that it was isolated was government expenditures. We saw that government expenditures were up 2.6% quarter over quarter. That was also isolated to the state and local governmental areas. Anecdotally, in my area, we are seeing a lot of road work taking place, both in my local community, my local municipality, and then also throughout the state. So there could be a situation, and I know this just from, again, our local community, that there's COVID money still being appropriated for projects before they lose that COVID funding. And so what you're seeing here is a really strong upward move back to trend in government expenditures and a strong move higher. Also, as a share of GDP, government is now roughly 34%. So to see that moving higher, that also leaves consumption as the other big component. Investments have been sluggish. Exports have always been a net detractor. So when you just look at just the general accounting principle of income, consumption plus exports plus government purchases plus investments, to me, it seems like only two components right now are driving this cycle. It's the government and it's the consumer. The consumer is waning, however, but the government is remaining extremely resilient, up 3.8% year over year relative to the trend rate of 1.3%. Here's real investments, as I mentioned, still negative, but a good increase in this report. This was the other strong suit outside of the government. It was mostly in structures and equipment and intellectual property. So it was nice to see some investments being made in this previous quarter here. Still well below trend, still well below the 2.1%, but hopefully we'll see investments continue to tick up. Remember, investments are a key component in my framework. I really subscribe to an old economist, John Hicks. He believed that investments kickstart cycles. He believed that there was an autonomous level of investment that was being made to replenish depleting machinery, depleting equipment, depleting structures and roadways and equipment. And so by making those base level of investments, you always have a steady stream of investments flowing into the economy. But periodically, you'll have these spikes of investments that are being made from period to period that kickstart your cycle upward along the way. All of those big investments, I believe, was made post-COVID. I think that's another reason why this cycle is remaining a little bit more resilient than others are giving it credit for. But those investments have been made. We need more investments to keep the cycle healthy because, again, as you're looking on this chart here, GDP is below trend. The trend since 1970 is 2.1%. And we're currently setting at 1.8%. Again, this is a year over year percent change, not a quarter over quarter, as we mentioned prior. Nominal. So if we adjust this for, if we don't adjust for inflation, nominal is continuing to come down at 6.3. That's still above trend at 6.1. I likely would expect the third quarter to push us below trend on a nominal perspective. And if inflation continues to cool, nominal may continue to head down, but real might continue to head up if and only if you get more investments made, if and only if consumption remains robust, and if inflation continues to come lower while GDP is moving higher. Again, my base case is that we continue to kind of trend sideways here for a little bit longer. We'll see if that continues to be the case. Here's one thing that's given me some pause because it is a big difference. So, I'm calling for this sideways move in the economy and in financial markets, but you're seeing things like the Chicago Fed National Activity Index, and you're seeing it declining. And then you're seeing the difference between GDI and GDP. It's probably not as noticeable, but you can see GDI is just a little bit less than GDP. You can see it much better on the cycle perspective. GDI has rolled over hard to the point where that looks potentially pre-recessionary. That's a little bit different here. These are supposed to be the same. It's an accounting method. If we consume as much as we make, that's the way that they quote unquote measure it, then we should be seeing these numbers look exactly the same. And for the most part, there's periods where they do look the same, like here and here, mostly all through this period, mostly all through these periods. So this discrepancy that you're seeing here, we need to take note of that. That's another signal that says, hey, even though I'm calling for this, sideways action, that the Chicago Fed National Activity Index and this difference between GDI and GDP don't necessarily jive with that. So again, that's why I mentioned investments. We need to see more investments being made. We need to see consumption remaining resilient, and it has been waning here a bit. So we'll see if that can be the case in the third quarter here. After we got the GDP report, because again, I think it was strong, but if you really strip it out, there's only two components to me that was strong. It's that government expenditures, and it was that small increase in investment from structures, equipment, and intellectual properties. Outside of that, I thought the report was more muted in nature. And again, maybe it looks a little bit more like this GDI GDP cycle that you're seeing here, that it's still a trend of an economy that is slowing down. It's still a trend of an economy that's growing below average, and one that is vulnerable to a recession if you have a shock, right? I think that's important. I've said that multiple times. Anytime the economy grows below trend, a shock can tip you into recession very easily here. Now, moving on, we did see like initial jobless claims continue to fall. We did see the Kansas City and the Richmond Fed. I don't have charts on these at the current moment, but Kansas City and Richmond continue to echo a struggling manufacturing sector, where initial jobless claims continue to show a resilient job market. We spent some time on this because one of my followers actually sent me a message and asked me about looking into it. But we did maybe make the conclusion that because jobs were plentiful, that maybe the reason why claims were coming down was that they were finding jobs quickly. I think that's still the case, given that the number of unemployed workers that are greater than 27 weeks, and given the percentage of people receiving benefits are still very low, that tells me that maybe they are entering the job market a little bit quicker than everybody's expecting. The other thing we are seeing, though, is the job openings are coming down. And that's also a direct comparison to what's happening in the employment cost index that we got on Friday. The employment cost index did come down, but just slightly. It was 1.2% on the previous quarter, 1% at this quarter. So we did see a reduction there. The biggest component was wages that helped it the most. We saw that in personal income as well. I don't know if I have a chart on personal income or not. I don't. We did see that on personal income as well. But to me, it's probably still going to be a part of the labor market here that's going to determine inflation in wages. Particularly here, what I'm seeing is a strong relationship between that ratio of job opens to unemployed workers. If that continues to drive lower, then I would expect these wages to continue to drive lower. What's interesting is seeing this chart and then flipping back to Fed survey data from New York, Philadelphia. We're going to get Texas next week, but Richmond, Kansas City, they've all echoed some level of wage pressure. Even anecdotally, I'm seeing it in my daily life with some of my worker, and then at the same time, seeing it in some of the institutions that we consult as well, hearing that they're still giving pay raises. So knowing that, it's definitely something that maybe there is some sticky element to this, but we're going to have to see. If you get layoffs, you're likely going to see wages come down naturally because those people will not be receiving a paycheck at that point too. Again, we're not seeing layoffs in masses. It's still a big reason why I don't think the Chicago Fed is illustrating a recession yet either, because that employment component is still being resilient. So let's move on to inflation. We got the core PCE. That came in just right in line with expectations. So just real quickly, core PCE was 4.6% on the prior month. It then changed to 4.1% at this month. Here's a look at food, services, and energy. I want you to focus on services real quickly. Services continue to be the key driver of this, but you can see how it has started to hook, and it looks like it has topped out and it has been coming lower for a while now. We can thank shelter. I definitely think shelter is going to be continuing to drive that lower because we have been seeing like apartment list and the Zillow home estimate of rent. Those have been coming down for several months before we finally started to see confirmation of it in the service side of the economy. Energy continuing to show some deflation here, minus 18.9%, and then food coming down pretty hard as well. So it's nice to see this trend of deflation or disinflation taking hold. We want to avoid deflation if we can, but definitely in the case of the inflation number, it echoed exactly what we saw in the CPI. Again, not too much of a surprise, but definitely another good sign for the Fed, another good sign that maybe they don't need to do anything else here. I think the pause that they did in July was right. I think they could have paused at this meeting, and I think they could have continued to let quantitative tightening run in the background here. I did have some slides on personal income, so I'm glad that I got a chance to bring this up. This is real personal income, and we've saw a strong increase of that thanks to inflation coming down. So it's currently at 2.26% year over year compared to the trend at minus 0.16. Just real quickly, a couple things on the income side. We did see a stalling of the income on assets, something that I have noted, but it's dividends, interest, rental income. Because we started to see a stalling here, that means that this acceleration here, a big proponent of this is inflation falling, I think, especially given that GDI is still down. It's likely that maybe incomes are moving somewhat sideways here. Now you get to see my dog run into the room here. There must be somebody outside. That's okay. So we're almost finished here. The other thing that I'll point out to close here is personal taxes. So taxes have come down dramatically, which also suggests that maybe incomes are lower, maybe squaring that with GDI and seeing GDI lower than GDP. Look at this reduction, a strong downward move in tax receipts out of personal income and out of wages. Again, almost $291 billion below trend. I think we have to note that. We have to take that very seriously. Again, because if incomes are lower, then my sideways consolidation could break lower if we do see some softening in the labor market. Right now, again, I'm going to stick to my sideways call. I do think that there's more tightening and more lagged effects that can take hold, and it's going to make us vulnerable to a recession. But if the Fed can stop here, and if the banks can find some happy medium to slowly raise their deposit rates while they start making new loans at higher rates, then their net interest margin will stay at a pretty constant level. And maybe we can continue to have funding in the economy without getting a credit crunch. I do have a measure of that. I've mentioned this to you all before. It's not in a chart here. To watch to see if there's a credit crunch taking place in real time, so it doesn't give you any forward indication. It just tells you that it's happening right then and now. You want to look at the spread between the 3-month and the 1-month, or the spread between the the federal funds rate. So really look at those short-term rates to see any spikes or any fluctuations. For those of you that are subscribers, I reported on my daily note. It's something that I keep track of. We're going to get next week, we're going to get the senior loan officer survey data. That will also tell us if there's a crunch happening in the background. So we'll definitely want to watch that and view that as well. That can help us, at least on a backward looking basis, see the health of the banks and understand the health of the banks. Outside of that, you are going to get more manufacturing data. You're going to get the ISM manufacturing data report. You're going to get the Dallas Fed, Texas survey data as well. And then you're going to roll into another jobs report. So again, I mentioned this, but for me, for the economy to keep trending sideways, we need more investments made and we need more consumption. Again, we didn't really see that in this GDP report. So I would like to see the employment side hold up here. I'd like to see the job openings hold. If those continue to come down, if we no longer have 200,000 jobs and we move into the 100,000 range, that again shows more deterioration in hiring. And then that will get concerning after a while to see momentum being lost in the labor market. And so we'll be watching that as well as productivity. Productivity has been extremely sluggish and extremely slow. There's some arguing, since productivity is so low, that they're going to have to lay off workers to kind of right size this a little bit here. Technology could help offset that. Could be why we're seeing intellectual property and equipment pickup. And so we definitely want to look to see if that's the case. So with that, I think this is a great place to stop. I do want to highlight that we will kind of give you some market updates throughout the week and what this data actually means for this. So stick with us on that. We'll be back again on Monday to give you a better update.